Be Wealthy and Smart, episode 1188.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the Fed's 10th consecutive rate hike and what that means, and are they going to pause in the future? What did Jay Powell tell us about it? We're going to break it all down and talk about that today. I waited specifically to do this podcast until after the rate hike and Chairman Powell's comments so that I could bring you current news on the absolute latest after he already made his decision. Because as I've talked about in earlier podcasts, the comments that he makes after raising rates are very important because they give an indication of what his plans are for the future, which is what everyone wants to know. Now, what happened today was there was a 10th consecutive rate increase, and that was aimed at battling inflation and bringing its benchmark federal funds rate to a range between 5 and 5.25%, which is a 16-year high for interest rates. Now, there was some very specific wording that Chairman Powell used and wording that he left out of his statement that he's had in prior statements. So we're going to break that down in just a minute. Now, the Fed is very data dependent, and they're looking for the latest data to determine whether inflation is cooling or not. And that will determine what they're going to do with future rate hikes. Inflation has been on a cooling trend, with the March Consumer Price Index rising 5% from a year ago, but it doesn't seem to be slowing at a pace that's fast enough for the Fed. And economic growth has also been slowing, and on Friday we'll get the jobs report for April, so we'll find out exactly what's going on with employment. But because we've had weakness in the entire banking sector, Chairman Powell really should be taking a pause and waiting to see how things go. I mean, if you really think about it, the entire mortgage refinancing business at banks has been completely shut down with rates going up so much. So nobody's refining their mortgage. That's been a very profitable sector for banks for a long time. But now with interest rates having gone up so much, people aren't refinancing their mortgages, and whole mortgage refi departments have been laid off. So that's a profit center for banks that they don't have anymore, which is making the banking sector even weaker because now they have lower earnings. Now, one major change that happened in the Fed's statement was the omission of a key phrase that it used in prior meetings, and that was seen as a sign that the central bank would keep hiking. And that statement that was in the March official Fed statement was, "The committee anticipates that some additional policy firming may be appropriate." That was the phrase that was in the March statement from the Fed that wasn't in today's statement from Chairman Powell. Now, it seems like such a silly thing that only one sentence could make a big difference, but it does. The new statement that Chairman Powell said was this: "In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments." So basically, they're saying we want to take some time and see what our cumulative tightening has done. We want to allow for that lag time that I've been talking about, the time that it takes for the rising interest rates to take effect and to take liquidity out of markets and cool off inflation, and to see what's going on with the banking sector. If we're in the middle of a banking crisis where small and regional and mid-sized banks are losing capital and it's all fleeing to the mega banks, this could cause a huge problem with, some people say, 100 to 200 banks that could be at risk of losing massive deposits and having a run on the bank. If that's occurring, the Fed has a real problem on their hands, and they need to shore up the banking system and reinstill confidence right away. Lawrence Yun, the chief economist for the National Association of Realtors, said the Federal Reserve's 25 basis point hike is unnecessary and harmful. He said inflation will be even lower as housing rent, a big component of the inflation reading, will inevitably slow down given the 40-year high robust construction of new empty apartment units. The rapid hikes have also upended the balance sheets of many small regional banks, he added. They are becoming zombie-like banks, unable to lend even to good businesses, as they are more concerned with balance sheet shuffling for survival. Yoon said stopping hikes and even cutting rates later in the year will give those banks a better chance of survival. Yeah, I think that's the big risk right now, are these smaller banks and what's happening to them as people are panicking and seeing that the mega banks like Chase are taking over the smaller banks that are having trouble. People are feeling scared, insecure, and not sure what's going to happen. So they're choosing to move their money to the larger banks, thinking that, well, they're going to end up there anyway, so they may as well just move their money to Chase now. And they're not really wrong. Ron Temple, chief market strategist at Lazard, said halting rate hikes may be necessary from here to see the Federal Reserve's tightening move through the system, which is exactly what I've been saying. We need to allow for that time to let the hikes work. Temple said the FOMC struck an appropriate balance between taming inflation while avoiding exacerbating stress in the banking system. Assuming banking issues subside, additional rate hikes may be needed, but it's time for a pause to allow the full effects of tightening to work its way through the economy. And that's exactly right. And the bond market has priced in lower rates from here, telling us that traders believe that the economy will weaken in the second half and will actually have lower rates. Now, that's not to say the Fed is going to start cutting rates right now, but it sounds like there is a pause on the table. That pause could be 1 month, 2 months, could be longer. We don't know. But we know that the language about raising rates consecutively was changed. And that's the way that Powell is indicating that his policy is slightly changing, which is from increasing rates to watching what happens. But Powell is still sounding very hawkish. He has not turned dovish. That means that he's still very conscious of attacking inflation. He said, inflation remains well above our longer run goal of 2%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. So he's definitely not backing down or indicating any kind of a cut, but he is talking about a pause. Powell also said he does not have an agenda to continue consolidating banks, adding that he sees value in having banks of different sizes within the system accomplishing different goals. He said, I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. Powell said that the summary of economic projections from the Fed's March FOMC meeting showed that decisions made up till that point in time had resulted in an appropriate level of rate increases. He said the committee will reassess the notion in June. He also said there are no promises in this, but it just seems to me that it's possible that we can continue to have a cooling in the labor market without the big increases in unemployment that have gone with many prior episodes. He said wage increases have been moving down, and that's a good sign, down to more sustainable levels. I think the case of avoiding a recession is, in my view, more likely than that of having a recession, he said. So he's on record. He is not anticipating a recession coming. So what could happen with the stock market if this ends up being the Fed's last hike for a period of time? Well, historically, the stock market gets a boost 1 month to 12 months following the end of the Fed's hiking cycle. When you look at what the S&P 500 performance has been, the S&P 500 has averaged an 8% gain and a 21% return in the 3 months and 12 months following a final rate hike in a series. So 8% in 3 months and 21% in 12 months following the end of the rate hikes. So again, we don't know if this is just a pause, but if this is the end, and if we do start to get weaker information in, then we will know it is the end, and the market will start to move up in anticipation of that. So all eyes are on the jobs report for Friday, and we'll see what the fresh data tells us. And I'll be following along this story and reporting back to you as we move forward. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.